If you want to place deposits for tenor that is around 1 year or beyond, then you may decide to receive the interest amount periodically, say every 3 months or 6 months, rather than getting all of it at maturity. The interest amount for each of the period will be calculated by the same formula PRT. The tenor for each interest payment will be computed based on number of days in the specific period. Principal and interest rate will remain same for all the interest payment period. Of course, you can opt for getting the entire interest at maturity too. A 2-year deposit that pays interest of 8% per annum semi-annually would pay an interest of 8.49% if all the interest is paid at maturity. Based on this, it may appear that the second option pays higher interest than the first option. That means, if you were to invest 10,000 rupees in a 2-year deposit that pays semi-annual interest, then it would pay interest of 400 rupees every 6 months. This is calculated using the formula PRT, where P is 10,000, R is 8 upon 100 or 0.08, and T is 0.5 year. We are making a slightly simplifying assumption that period of 6 months is exactly half a year. Thus, we receive total interest of 1,600 rupees over a period of 2 years. However, if we choose to get all the interest payment at the end of 2 years, then the interest rate is 8.493%. Thus, the interest amount would be P of 10,000, R of 8.493 divided by 100, and T of 2 years, and that gives us the interest amount of 1,698.60. Thus, it is giving additional interest of 98.60 compared to the deposit where we get the interest paid every 6 months. This happens because the interest that is not paid to us is added back to the principal every 6 months. Thus, the value of principal rises every 6 months. This higher principal then starts earning 8% per annum interest for the rest of the period. Let's see how this works. We can say that we invest 10,000 rupees to start with. At the end of first 6 months, 400 rupees of interest is due. Instead of being paid to us, it gets added to the principal. Thus, the principal for next 6 months becomes 10,400. The interest earned in the next 6 months period, that is from 6 months to 12 months, would be 10,400 multiplied by 8 upon 100 multiplied by 0.5, and that is equal to 416. This will get added back to the principal, and hence the new principal will be 10,400 plus 416 equal to 10,816. This would be the principal for next 6 months, and the interest due at the end of 18 months will be 10,816 multiplied by 8 upon 100 multiplied by 0.5, and that is equal to 432.64. Adding this back to principal, the new increased principal is 10,816 plus 432.64 is equal to 11,248.64. Repeating the process for the last time, as we will be reaching the end of the 2-year period, which is the maturity date of the deposit. The final interest amount is 11,248.64 multiplied by 8 upon 100 multiplied by 0.5, and that is equal to 449.95. At maturity, we must get back the principal, which has increased to 11,248.64 plus the last interest payment of 449.95. The total is 11,698.59. At overall level, we may see this as an investment of 10,000 at the start with a maturity value of 11,698.59. We could say that from this 1,698.59 is the interest amount, and if we divide that by 2 years, which is the tenor of the deposit, it comes out to about 849.30 per year. When this is translated as a percentage, the return works out to 8.493% per annum. This has happened only because we did not take the interest semi-annually and received it all at the end. The bank allowed you to earn interest on such interest payments that was not paid to you during the life of the deposit. This is nothing but compounded interest. One can calculate the maturity value of compounded deposit using the formula maturity value is equal to principal multiplied by 1 plus r divided by n raised to the power nt. Here, n is the number of interest period that gets compounded per year and t is the total tenor of the deposit. In our previous case, the principal P was 10,000, rate R was 8 upon 100 or 0.08, tenor T was 2 years. The value of N was 2 as we have 2 semi-annual interest payments per year. The formula gives us exactly the same number, 11,698.59, as what we had calculated in the previous exercise. We show here that the actual interest being paid by the bank is same in both the cases, which is 8% per annum. The choice of going for periodic interest payment or interest payment at maturity is based on your cash flow needs. Interest earned on fixed deposit is fully taxable and it will get added to your income for the financial year. We would like to add here is that banks are not the only firms that offer fixed deposit investments. Many large companies and financial institutions also offer fixed deposits that individual can invest in. Usually, the deposit rates offered by them is slightly higher than what the banks may offer, and it is due to higher credit risk. We have talked about credit risk in another video. At the end of this video, you should feel very comfortable with fixed deposit as an instrument and should be able to work out the interest amount and maturity value for both simple deposit and compounded interest deposits.